Hello. In this video, I'm going to talk about some results within the statistatorium, evaluating those results and some of the questions that these results have actually answered. I'm also going to talk about a few of the questions that haven't been answered just because I didn't know what I needed to ask. But yet, the statistatorium gave me answers that have been staring at me for a week or more. In fact, I've spent 2 weeks analyzing these data points to try to determine a few things that I was seeing within my trading. Now, this video is going to be kind of a round robin of topics that by themselves have merit, but for the complexity of the data are interconnected. Let's start with the big and first question. When you use a discount coin, KCS for KuCoin, FTT for FTX, or BNB for Binance, are you really getting a true discount? Or is it costing you more in the long run? The answer to this question really is twofold. The short answer is no, you are not getting the discount. The longer answer is you might be getting the discount, but only if you know how. Let's take a look at this chart, and as you can see, I have spent over $120 just in KCS for my discounts. Now this is a complete loss on my books. No profit has come from this. This is money out of my pocket. So for my short answer, I've lost money in my trading using the discount coin. I've actually spent more money than I've made. So let's take a look at the graph, and let's focus in on one area. As you can see, the amount decreases because it pays for my fees. The spikes upwards are where I've made purchases. So you can clearly see where I've made purchases to replenish this asset, but then, through the process of trading, have consumed it. So I am not making a profit on this asset. I am losing money. I am losing a lot of money. But there is a way to turn this around. And that is in a separate sub-account, trading only this coin. But you need to be sure that your returns exceed what you actually consume on a daily basis for your fees. So you need to figure out the mathematics of what your fees are on a daily basis, and then make sure you invest enough money in your second sub-account to at least make that back. In my case, I've spent as much as $2 a day in fees. So that means I need something capable of generating $2 a day. Now, since most recipes operate consistently around 1%, that means I need to trade minimum $200 a day to get $2 a day. So my sub-account has to have a minimum balance of $200, and I have successfully traded every single day $2 profit in order to break even on my fees. Now, realistically, that's not going to happen. The law of averages will give you an average of $2 a day with the right recipe, but you're just not going to make it guaranteed every single day. So there's still going to be cases where you're going to lose just because you're paying more fees than you're generating from the asset itself. So really, just purchasing the discount coin and not actively trading it, not actively replenishing it, is costing you more money than if you were to trade without the discount to begin with. Because you've purchased the asset. You pay a fee on purchasing the asset. So the coin that you're supposed to be using for your discounts, you've paid a fee on it. So if you spend $20 in KCS, you're going to pay 0.2% fee. Right off the top, that's your fee. Doesn't sound like much, but when you look at how frequently it takes place, it adds up. $120 so far is what I've spent. It doesn't look like $120 when you look at a few of the actual transactions, but these add up quickly. So from the standpoint of your statistical analysis, you might need to rethink how you handle your fees if you don't actively trade to increase your holdings. Now, I need to point out, you cannot trade your magic coin in the same account you use to pay fees, because you will cannibalize your trading and lose even more money. So in my case, I have to have a sub-account to earn KCS in trading so that I can use it to balance out what I'm spending in fees. If I try to do this in one single account, that is, if I try to trade KCS in the same account I'm paying fees, then every time I'm trading, I'm cannibalizing it faster than I'm actually earning revenue. And that will cause you losses in the long run. So you need to be aware of that critical fact. If you want to profit with a discount coin and really take advantage of the discounts, you need to have a separate active trading process that earns that coin. Just spending money on it, purchasing it along the way, you're actually losing money in the long run. Now that process actually connects into the next part, which is a bit of a strange anomaly, where the answer is right in front of me, but I actually didn't see it for quite a while. Here is a chart of my transactions for Glitch. Now these are realized transactions, so you can see I'm about $100 underwater. But this chart has a lot of hidden secrets, and I'm going to zoom in on one of them. An interesting secret of all things. One that I actually didn't anticipate. Here's a nice, neat little sideways market, but it's trending downwards. I'm losing money even though I'm making money. Same thing here, a nice neat little market trending downwards. Let's see what's going on here. Now this is interesting. A complete nice little sideways market. Now this ties into your fees because when you look at this, even though there's enough profit here to cover my fees, there's actually something more sinister going on. So I come down here, I make a purchase, it goes up here, it makes a profit. So let's zoom on this a little more. So purchase, profit, purchase, profit. But why is there a downward slope? I'm making profits, so why am I actually losing value? Well, that's because I became the whale in the pond. Now, you would think that me saying that I was trading $100 a position for this coin. I wasn't. I was only trading one position size of roughly $1.80. $1.80 per position. And yet, I was the whale in the pond that the piranha was feeding on. It took me a while to figure this out because I went through the order book, I went through the ledgers, did a complete hand analysis of all of the entries, and they all showed a profit. But then I realized something that really isn't spoken about, but inadvertently it occurred in this case. And I have other examples of this. Because of the frequency I was trading, I was creating volatility. That volatility was causing a movement in the market. So I would create the volatility, move the market, and then sell on the volatility I created. What you're seeing here is actually the impact of that effect. I was draining the order book of liquidity because I was trading it too fast. Because I was the whale with my position size, I was actually directly affecting the order book. The actual volume and price action in the order book was losing value because of this aggressive trading cycle. So even though I was making my full profit each and every time without failure, the high frequency trading was bleeding the order book. I was the only one actually in the market at this time, save one other piranha, the exchange, charging me fees of 0.1% each and every time I made a transaction. So because I was pushing the market so aggressively, the piranha, in this case the exchange, was quite happy to cannibalize the position in the process of filling it, which is why you see the price actually dropping and losing more value. You would think, with me being the only one in the market, that the asset would appreciate, and it would if there was somebody else in the market besides me adding liquidity from my purchases. But because of the frequency, the liquidity I added, I took back out. I actually pushed the market so aggressively, I moved it. That is something you don't want, and it can be a disaster. As you can see in multiple areas. Now let's move to another area. I'm going to zoom in, and you'll see multiple times I became the whale. Multiple times the portfolio was cannibalized over and over again because of the aggressive trading frequency. Let's take a look at this one here. So when you're trading high frequency, be aware that you can become the whale. You can offset and upset the order book so much by the level of frequency that you are trading. Remember that equilibrium runs at 1 second intervals. Most order books aggregate over several minutes. So when you're at the 1 second interval, you are right at the edge of the order book wall. You are literally pushing the next level. Whether it is adding liquidity to the market or taking liquidity from the market, at that level and speed, you are likely to be the only one pushing the order book, with the exception of the exchange taking its fees, cannibalizing your position in the process, meaning degenerating or degrading the value of the asset in the process of your high frequency trading. So you need to be aware of that and pay close attention to it, because you see the impact of that when you move the market. Well, other traders will see it, because in this case, I was the whale in the market. I triggered a response. That response was people made a purchase. And as you can see, the big spike up. Other traders seeing my movement, they made purchases. But then they cannibalized my position again. And I started losing money. So when you're trading an asset, your percentage is just as critical as your frequency. So if you have a 0.3% boundary and you are not in a market capable of handling that frequency, you will become the whale and you will have your portfolio cannibalized. But that is not always the case. And I'm going to demonstrate now another coin that's just the opposite. But it's a coin you wouldn't think would be. So let's take and zoom in on some areas here. Here is actually a stable sideways market. I am profiting. I'm not the whale. That is, there's other people in the pond aggressively trading at a high frequency, the same level that I am. So I'm not moving the order book. That's important. Now let's see if I can find the one area that's really fascinating. Okay, again, you see the order book is stable. The frequency is stable. That's the kind of things you want to see. You look at the peaks and you see, here you can see there might be some questionability. But here you can see the peaks actually go higher. Very little, but I am actually making a little more each time. That is what you want to see. As you can see, this is you actually profiting in the market. This is the direction you want your order book to show on your transactions. Small profits. And it's not always easy to see, but that is really a legitimate profit in the asset. So as you look through your ledger, pay attention to the little details. Look to see if you are the whale or the piranha. If you are the whale, you need to take concerns and steps to change your trading pattern. If you're the piranha, you might want to tune your trading to maximize the impact and effect. Trading is a zero-sum game. The irony of it, though, is you could be the zero-sum. And that is the strange part of the whole process. So let's see this here. Okay, as you can see in close inspection, you see an upward trend. There are a few points that go downward, but overall average is upward. This is where you want. This is how you tell you're making real money. These are realized transactions, not empirical, not theoretical. They are said and done. This is money in your account. But now let's get to the most severe case of cannibalization. The one that was a surprise. And as you can see, it's plainly visible. At first, I thought this was a bug or an error in the program, but it wasn't. I was actually being cannibalized in my position value. There's no mistaking this downward trend. It's aggressive, it's steep, and my portfolio is losing value. And as you continue to zoom in, you can really begin to see the impact and effect of where I was trading so aggressively and so frequently. I was moving the order book just by my own trading, with the exchange cannibalizing its own price action just within the fees. So this is an extreme case, and the irony of this is only a $5 position size. And yet, when you see it like this, it just doesn't register that that little could make that much chaos in your portfolio. Now, I have since changed my trading and figured out a different approach. As you can see, my line of volume is nowhere near what it was. And the aggression to which I am trading is also nowhere near what it was. Just because this asset can't handle it. It cannot handle the level of trading I was doing. So if you see these patterns, you're trading too aggressively. You're cannibalizing your own portfolio. You need to adjust your boundary, and you need to adjust your position sizes. Now, it could be either or. In my case, it was both. So in terms of your order book, take heed to what the statistatorium tells you. Pay attention to when you see good trading patterns versus questionable trading patterns, where you need to zoom in and actually see, are you really making money? Which here I am. This peak is higher than this peak. So this coin is sustaining a 0.3% trade. And you can see it here as well. Let me get back here. You can see the impact of the trading. And that really is the point. You want to be able to see an upward trend. If you see an upward trend, you're gaining value in your portfolio. If you see a downward trend, even for winning, you're losing value. That is the biggest factor you must be aware of. And using your mouse to inspect these charts is absolutely critical. Take the time to drill down, look at your trading, and see exactly when, where, and how much. Especially when you see unusual heavy density patterns, because they are suggestive of a severe problem that could be in your favor or against you. For this particular coin, it's in my favor. I'm making money with it. But for glitch or sushi, it's not in my favor, and I lost a lot. Now, as you can see, here is my zero line. This coin is in pure profit. So no matter what I'm doing, I'm making money on this coin. I am roughly $17 to $19 above water on this asset. Now this is an asset that has an unusual history, and it still needs to be observed carefully. It's not really a high frequency trading asset, but at the same time, it does do well with a boundary of 0.3% as long as your position size is small. If you increase your position size too much on this coin, then it becomes a death trap, and you end up taking on a lot of positions. Unfortunately, finding out what the perfect position size is a guessing game. For me, I found that 2 lots works well, but I've been as high as 5 and 10 lots, depending upon the market. So always pay attention to exactly when and where the market is moving. Okay, let's look at another coin that is interesting to say the least. Here you see a coin. You see the same kind of patterns, these clustered effects. So let's see if I'm making money on this coin or if I'm being cannibalized by the piranha. Okay, let's zoom in on the peaks. And then already you can see, yes, I'm actually making money. So this coin is doing well with a 0.3% boundary. But I'm only trading 2 lots on this coin. If I raise my level of pricing, then I am very much likely to end up in the same position here that I did on sushi and serve. So you need to be aware of that impact. Not every coin can handle the high frequency trading. Some coins can, some coins clearly can't. As you can see, the downward cascade, where this coin clearly couldn't, but then when it got here, it improved. And it got enough interest from other traders that it was able to start handling this high frequency trading, and I was starting to make money. But you could see in the beginning, it didn't do so well. And even still throughout, there were still questionable areas that made me really wonder if this coin was worth trading. Drill down. Use the statistatorium to help you fine-tune your trading. Look at your fees. Look at how much you're spending on that magic coin. Do you have a way to trade your fee-based payment coin to make a profit? That is it just a sinking ship, or are you actually actively profiting from the coin you are making use of for your fees? Those are the kinds of questions you have to ask. Those are the kinds of questions you have to look at. Because the bottom line is very simple. If you don't, you will see your portfolio bleed. You will see the consistency of a downward slope. And you will see an overall downward path, wondering why you are losing that momentum. So it's important that you really take a look at these charts. Take the time to drill down and actually really look at them. For example, this is Black Crow Hunter. Let's zoom in, and I'm already at roughly $22 profit. But you see how frequently I am actually trading. Not very frequent comparatively speaking. But it's doing well. And you see my one position of roughly $261. Take careful heed to these charts. A lot of times it's going to give you answers, but you're not going to know the questions. That's where you need to really take the charts apart. Study them. Learn from them. Find out what they're really saying. Figure out what questions you need to ask. Because in the long run, your answers aren't going to help you if you don't have an understanding of what you're looking at. Because you might very well have the perfect representation of a very profitable asset right under your nose. Or you might have a losing situation right under your nose and not know it without taking and analyzing this situation carefully. For example, XMR has turned out to be a surprisingly profitable coin on 2 lots. Okay, I think I've rambled enough on this to cover a lot of details, particularly within the unforeseen nuances of what the statistatorium can show. Remember that the devil is always in the details, and those details can hide a lot of dirty little secrets. Here's another coin that I got cannibalized on, but then it started to turn around and it looks like it might be gaining strength. We shall see. So understand your trading, understand your transactions. Use this information to help you benefit, because with it, it can help you improve your trading. It can help you make money. And that's really what all this is about. Turning things around. Stopping, starting, and looking at the markets and making sure you're going in the right direction. The direction of profit. Like, subscribe, share this video if you know somebody that's having problems with their profits. Leave a comment below. Feel free to ask questions. And take the time to really study your trading. Learn from your trades. Automated trades are often overlooked because software does all the dirty work. But they're no different than manual trades. You need to study the results to determine if you're going in the right direction or not. Not every market is a good market, and not every market can support high-frequency trading. Sometimes the hard part is seeing which ones can and can't. Until next time.